thanks for tuning in to our weekly Mortgage and Economics segment. I'm Megan Abdelaziz, RealEstateSINY.com's Mortgage and Economics reporter. The mortgage rates took a little step down this week. The 30-year fixed rate is now at 4.56%. The 15-year fixed rate is at 3.65%, and the 5-year adjustable rate is at 3.56%. These decreases in the mortgage rates came from Ben Bernanke's recent statement to Congress. Ben Bernanke, the chairman of the Federal Reserve, met with the House of Representatives Financial Services Committee on Wednesday, July 17th, to speak about the monetary policy. In this statement from him, he pretty much has said what he has been saying in the past statements he has made, but with a slightly different spin to it. After his previous statements, investors were getting worried because he was more specific with when they might end the quantitative easing program. But this time, he was a little bit more clear and emphasized more that there is no particular date as to when they will stop the program. It all depends on the labor market, mainly the unemployment rate, getting better, and whether or not the rest of the economy will keep improving. At the end of June, we covered a story about the stocks dipping due to Ben Bernanke's statement after the Federal Open Market Committee meeting. And as we predicted, they aren't quite ending the quantitative easing program, and there was no need for commotion. Now that investors have calmed down some after Ben Bernanke's last statement, the financial markets are getting better. The Dow Jones and the S&P 500 were both up and down slightly this past week. But after his statement, they had started going back up. The Dow Jones had opened at 15,298 on Thursday, July 11th, and had gone up to about 15,484 by closing bell on Monday, July 15th. It had went back down slightly on Tuesday, but had come back up to about 15,470 by closing Wednesday, July 17th. As for the S&P 500, it had opened on Thursday, July 11th at about 1,657. By Monday's closing and Tuesday's opening, it had reached about 1,682, and then had come back down Tuesday into Wednesday. By closing on Wednesday, July 17th, it had gone back up to about 1,680. The interest rates were also improving this week. The 10-year U.S. Treasury bond yield had gone from 2.7% on Wednesday, July 10th, down to 2.52% on Wednesday, July 17th. After checking into what was happening in the financial markets, we took a look at the newly released economic data. First, we looked at the advanced monthly retail and food services sales for June. This report was released on Monday, July 15th. By the U.S. Department of Commerce. In this report, they gave their advanced estimate of sales in the retail and food services sector, which came in at $422.8 billion. This is a 0.4% increase from May, and it is 5.7% higher than it was in June 2012. Next, we looked at a report on foreclosures for June, released by RealtyTrac on Thursday, July 11th. In June, according to RealtyTrac, the amount of foreclosure filings, which includes notices of default, scheduled auctions, and bank repossessions, was at 127,790. This is about 14% less than it was in May, and it is the lowest it has been since December of 2006. Foreclosure starts were down 21%, and bank repossessions were down 9% from May as well. As the home prices improve, more people are either able to sell their homes before they are foreclosed on, or they are able to save their homes and keep them. The United States Census Bureau and the Department of Housing and Urban Development released their newly residential construction report for June on Wednesday, July 17th. For the privately owned homes, there was a 7.5% drop in the amount of building permits authorized, a 9.9% drop in the housing starts, and a 6.3% increase in the amount of privately owned houses that were completed. If you compare this year's numbers with last year's, we see that things have improved. For the single-family homes, there wasn't that much change. The single-family housing permits authorized were 0.6% higher. the housing starts were 0.8% lower, and the housing completions were 1.1% higher than May. Now that we have seen how the economy is actually doing, let's take a look at how the mortgage applications are going. The Mortgage Bankers Association released their weekly application survey on Wednesday, July 17th for the week ending July 12th. This week, the Market Composite Index fell another 2.6%, and the Refinance Index fell another 4%. The Refinance Index is now at the lowest it has been since July 2011. Though the Refinance Index continues to fall, refinances have been making up most of the mortgage applications being applied for, coming in at 63%, the lowest it has been since April of 2011. Lastly, we looked at Gallup.com's weekly economic confidence report that was released on Tuesday, July 16th. This report has the results for the week of July 8th through July 14th. The results they received this week came back even more negative than they were last week, even with the improving economic data being released each week. The net ratings of Economic Outlook came in with results of 43% of Americans feeling that the economic outlook is better, and 53% feeling that it is worse. The net ratings of current economic conditions came in with results of 19% thinking that the conditions are excellent or good, and 33% thinking that they are poor. With these two polls, they created Gallup's weekly economic confidence index of -12, down from the -9 they reported last week. With investors finally realizing that the quantitative easing program will be staying for a while, we could see the mortgage rates remain somewhat stable in the coming weeks, but because they are so volatile, nobody really knows where they will go. Make sure you check back with us each week at trendingsimy.com and here on YouTube to see where the mortgage rates go next. Thank you for watching, and be sure to like us on Facebook, follow us on Google+, subscribe to our YouTube channel, and follow our blog at trendingsimy.com. Once again, this is Megan Abdelaziz with RealtyTrac.